Live episode 3, where we map out and navigate the road ahead with current housing market insights, trends, and new product updates. Today, we're here with Benchmark COO and TMBA President, Steve Remington.
Thanks, Megan. Glad to be here today.
All right, well, let's go ahead and navigate our first road sign in our current markets.
So there's a lot of housing data out this week. So two major housing indexes, the FHFA Home Price Index and the Case-Shiller Home Price Index, both showed a slight reduction in home price acceleration, I'll call it. So yes, we still see some appreciation in home price, but it's not the same rate we were seeing before, 1.4% for the FHFA index, 19.75 on the annual index for the home price index with Case-Shiller. The new home sales data came in a little bit cooler than expected. So it came in at 590,000, was expected at 650,000, really showing some cool down in new home sales. And then this morning we had the pending home sales data, which showed an even more dramatic slowdown at down 8% on month over month and down 19% year over year. So clearly what the Fed is doing by raising interest rates is having that cooling off effect on the housing market. So raising interest rates, slowing demand, causing that little bit of a pause, and then bringing price expectations down a little bit. You know, you'll see a lot of doom and gloom if you read the news. This is not doom and gloom. This is just cooling off an overheated market. And a lot of the research I'm reading, people are talking about, yes, the number is down, but we're not predicting a crash of sorts.
Good. Thank you so much for going over home sale data and our topic 1. Let's shift to topic 2, which is today's a big day.
Today is the big day.
The Fed meeting.
So every 6 weeks, the FOMC meets, the Federal Open Market Committee, to make the final decision on what to do with short-term Fed funds interest rates. The meeting will conclude at 1 p.m. Eastern time today, so just about an hour for it for now, if you're on the live stream. It's expected that rates will go up another 75 basis points on the Fed funds, so the new target range is 2.25 to 2.5. And then if you look at the probabilities, this is where the market, the people that are investing in Fed funds futures contracts, are setting an implied rate of 0.78. So the market is 99% certain that we're going to get a 75 basis point increase in Fed funds. The good news in that is mortgage rates are actually held pretty steady. We've actually come down a little bit from the peak we saw back in June.
Oh, that's good news.
Yeah.
Awesome. Well, thank you for giving us a little insight into what's to come today with that Fed meeting. Let's shift to topic 3, which is our interest rates historically.
So what the Fed does to short-term rates is not a direct one-to-one relationship of mortgage rates, but in the end it does have an impact. So Fed, as soon as we anticipated the Fed would start increasing rates, mortgage rates shot up earlier this year. The good news is, you can see on this graph, rates have moderated from those highs that I mentioned back in June, and we're hovering in that kind of 5.5 to 5.8% interest rate range. You know, we topped over 6 there for a minute back in June. So this is a graph of year to date, the average conforming interest rate, and you can see how things have leveled off. Good news is the Fed funds move today, and the next several moves have already been baked into the market, so we don't really anticipate a lot of volatility, and we really have a 6-week break now after today to really kind of look into the inflation numbers and all the other drivers to really anticipate what the Fed's next move is after that.
Good to know. And for those of you just tuning in, let's recap with Steve's keys.
So first key, things are starting to cool off. The Fed moves are having the intended impact. It seems like it hits the housing and real estate finance and mortgage markets first. But we're starting to see rates go up, home prices come down a little bit, home sales come down just moderately. But it's not getting cold, it's just not as hot. So good news is the intended effect seems to be happening.
That's great. And then for your second Steve's key.
So today's a big Fed day. We think we know what the decision is going to be, but we're going to be carefully monitoring the press conference after the Fed meeting to understand kind of the finer points and the footnotes of the Fed meeting to really determine what's going on. But really, we're optimistic that things will continue to be stable here in the short term. It seems like rates are not that high if you look in comparison of back in the 90s and the 80s.
Yeah.
There's only 1 or 2 times that rates were really higher than this in the last 10 years.
Nice. And last but not least,
business is actually picking back up. So we saw a seasonal dip in activity for applications and rate locks and home sales around the 4th of July holiday. But just in the last several days, application volume has picked back up here. We're starting to see more inventory in some of these markets, in our centralized markets, and we're starting to see increase in rate lock activity. To me, that's a positive sign that we're doing well and our partners are doing well.
That's awesome. Well, thank you so much, everybody. That's all the time we have for today. Thank you so much, Steve, for coming on the show. Just a reminder, we do want your questions to be featured, and we want them featured in next show. We didn't have a question come through for this time, but please leave any comments, questions in the live stream chat, and also you can send to communication@benchmark.us. See you all next Wednesday on Mortgage Minute Live.